Hello friends, today's topic is bond washing or dividend stripping transactions which are taxable under section 94 of the Income Tax Act. In this topic we'll be studying where the SSC is involving into an arrangement that is avoiding the interest income from bonds or securities, is able to avoid the interest income, and if it is proved that the transaction was entered into by the SSC only to avoid interest income or to take any sort of benefit by not indulging in taxability of interest, then in such a case such interest income will be taxable in the hands of the SSC. It will be deemed to be an income in the hands of the SSC, as well as dividend stripping, wherein any loss incurred from sale of shares on or before the dividend date, such losses incurred will be restricted to the dividend income to be received by the SSC. So friends, the next topic of bond washing transaction and dividend stripping, the relevant section in this case is section 94. Section 94.1, subsection 1. Let's take the first subsection, wherein the SSC is indulging into practice of selling the security and after some time it is reacquired, meaning just to avoid the interest income, the SSC is indulging in such practice of selling the security and then reacquiring the security. So friends, you may be aware that generally interest is paid for a certain period. I mean, there is always a time gap in paying your interest. There is a due date of paying your interest. For example, interest on a saving bank account, you may be getting it quarterly or half yearly. So SSC, let's say, is getting a half yearly interest on the securities. Just to avoid the interest income, what the SSC has done is they have sold the security. He has sold the security just before the due date of interest income to be received. Let's say the due date is 30th of September. Then on 29th of September, he has sold the security. The same is sold to a related party, to a relative, and on 1st of October, he reacquires the interest so that the interest income, the income which will be received from such securities, won't be taxable in his hands, and such interest income will be taxable in the hands of a relative. And it might be a thing that the SSC's income is the SSC's income is exceeding the slab benefit, and accordingly such an amount will be taxable in his hands, whereas the relative's income is less than the slab benefit, and accordingly such an interest income would be such an interest income won't be taxable in the hands of his relative, and accordingly SSC is indulging into practice of selling the securities and then reacquiring the security at a later point of time. If such an arrangement is proved, and if it is proved that this action was taken by SSC only to avoid interest income, in such a scenario the entire interest income will be taxed in the hands of transferor. The entire interest income will be taxed in the hands of the SSC. Correct? On your screen. And before moving on to subsection 1, subsection 2 also, it is related to interest income, wherein securities along with interest is sold by the SSC. Securities along with interest is sold by the SSC just to avoid the interest income. Meaning, for the period from April to March, SSC has sold the security in the month of December. For 9 months, he was using the security, he was invested in the security, and thereafter he has sold the security along with interest income. Securities cum interest has been sold to the buyer. In such a scenario, I mean, the intention of the SSC is to avoid interest income, and obviously there is no intention of repurchasing the securities. Let's start of repurchasing the security. He has sold the security along with interest to a buyer. Now, interest income ideally was due for 9 months, and on due basis, it should be taxed in the hands of the SSC. Keeping that in background, what subsection 2 could start? What subsection 2 of section 94 states is such a securities along with interest, if sold to avoid interest income by the SSC, then interest income for the year will be taxable in the hands of the SSC. So interest will be calculated on such securities and will be deemed income in the hands of the transferor. Correct? So subsection 1 and subsection 2 of section 94 are related to interest income which the SSC cut start which the SSC is trying to avoid, and it will be deemed income in the hands of the SSC. Bond washing transactions, subsection 1 and 2. These are bond washing transactions, and dividend stripping we will be covering in subsection 7 subsequently. So let's read out subsection 1 and 2. Securities sold. Securities are sold sometime before the due date of interest and reacquired after the due date is over. This practice is adopted by persons in the higher income group to avoid tax by transferring the securities to their relatives friends in the lower income group. Correct? This was the example that we took. In such a case, interest would be taxable in the hands of the transferee, who is the legal owner of securities. Second pointer means to say, by way of this arrangement, what used to happen was the interest income was taxable. The interest income was taxable in the hands of transferee. By way of this arrangement, ideally it should have been taxable in the hands of the transferor, the SSC. In order to discourage such practice, section 94(1) provides that such interest income will be deemed to be the income of the transferor and will be taxable in his hands. Correct? So the deemed income, the interest income, will be taxed in the hands of the transferor, which you can say is similar to clubbing provisions. Right? So subsection 2, friends, in order to prevent the practice of sale of securities cum interest, the provision provides that if an SSC who has beneficial interest in securities sells such securities in such a manner that either no income is received or income received is less than the sum he would have received if such interest had accrued from day to day, then income from such securities for the whole year would be deemed to be income of the SSC. So, notional income will be calculated wherein interest which has actually become due to the SSC will be subject to tax in the hands of the SSC as per subsection 2 of section 94. So friends, these were bond washing transactions as per subsection 1 and subsection 2. Now friends, dividend stripping transactions in which the dividend is trying to be avoided by the SSC. Ideally, if you see, under 1014, the listed securities, the dividend income is exempt. However, for other dividend income received, it may be taxable in the hands of the SSC. And just to avoid the dividend income, what the SSC has done over here is, to fall under subsection 7 of section 94, you should be purchasing these securities, the units, before 3 months from the record date. Record date is nothing but the date on which the dividend will be paid to the SSC, right? And before preceding 3 months of the record date you have purchased, right? And thereafter such person has sold the securities in within 3 months of the record date or within 9 months of the record date in case of units. So friends, the intention is not to avoid dividend, but the intention is to earn dividend income, and dividend income will be exempt in the hands of the SSC. Also, generally, in such a short period of time, there is a possibility that there is a loss on shares on units. So you can say there is a double benefit which is accruing to the SSC in the way of dividend income he is receiving, no doubt, which is exempt, which is not taxable as per section 1034, right? So the dividend income is exempt in the hands of the SSC. And now, by selling the securities, by selling the units, let's say he has a loss from selling the securities, and such loss now he can set off against the short-term capital gains or long-term capital gains dependent upon the holding period. And in this case, obviously the holding period is less than 3 months or around, you can say, less than 1 year. So it will be a short-term capital loss, and short-term capital loss, friends, can be adjusted against short-term capital gain as well as long-term capital gains, correct? So dual benefit is available to the SSC, wherein dividend income is exempt and loss is also getting set off. So just to deny the SSC the benefit of dual deduction of dual benefit, is to deny the SSC the dividend income. Let's say amount is 50 and loss is 200. So the loss which can be set off will be restricted to the dividend income, cut start to the dividend amount, meaning loss will be 200 and dividend income of 50 rupees will be adjusted against the loss, and only the remaining amount of 1,50,000 of 150 will be allowed to the SSC for set off, correct? Again, shares and units, these are the two factors wherein shares, if purchased before 3 months of the record date and sold within 3 months of the record date, 3 months before purchased, 3 months after sold. In case of shares, then dividend stripping will be applicable in case there is a loss from the transaction, right? This was for shares. For units, 3 months before the record date purchased and 9 months after the record date sold. These units are sold within a period of 9 months of the record date, and there is a loss from such transaction of units purchased and sold. In such a case, what will happen is dividend stripping will be applicable as per subsection 7 of section 94. Dividend stripping means dividend deduction. Dividend would be deducted from the loss which has been incurred by the SSC from such transaction. In our example, loss was 200 rupees and 50 rupees dividend income which was exempt under section 1034. Such dividend income will be deducted from the loss incurred, and accordingly loss which will be available for set off to the SSC will be 200 minus 50, and ultimately 150 only will be available to the SSC as per subsection 7 of section 94. Friends, practically if you see, this subsection is very much relevant for you, wherein generally when practically you are filing your return of income, any individual's return of income, you will find a number of capital gains transaction has taken place. I mean, if a person, you can say 3 to 4 out of 10 person usually deal in capital gains, and you will find transactions, which has been sold within a period of 6 months, 7 months. I mean, they have been purchased in the current financial year and has been sold in the current financial year as well. And that too within a period of 1 month, 2 months, 3 months, even a shorter period. In the cut start. So in such a case, what practically you will have to do is for that particular scripts that you have noted down in which there is a possibility of dividend stripping, for that particular transaction you will have to analyze, you will have to ascertain the record date of the dividend. The record date of the dividend you will get from the website. It is available on stock exchanges website, wherein the dividend declared date, the record date is available for that particular entity, listed entity. And then based on the record date, you will have to determine what is the purchase date and what is the sale date. And if it falls within the range which has been mentioned under subsection 7, then dividend stripping may be applicable. And also, if there is a loss or not, you have to ascertain. If there is a short-term capital loss from the transaction, then only dividend stripping will be applicable, right? So, for applicability of dividend stripping, as per subsection 7, buy date, purchase date, sale date should fall within the prescribed range. There should be a loss from the transaction, right? If yes, if these two conditions are satisfied, then dividend income which has been received by the SSC will be adjusted against the loss amount. If in an example, let's say the loss was 30 only 30 rupees was the loss. However, dividend income is 50 rupees, then 30 rupees entire loss will be netted out, will be nil. The loss will be nil effectively. I mean, there will be no scenario that dividend income will be taxed, but the benefit of setting off of loss won't be available to the SSC to the extent of benefit taken by SSC in the form of exemption of dividend income. Correct? So friends, on your screen, section 94.7 provides that where any person buys or acquires any securities or unit within a period of 3 months prior to the record date. So 3 months before the record date, you have acquired the asset, you have acquired the securities or acquired the unit. Such person sells or transfers securities, this is for units, securities within a period of 3 months, so after 3 months of the record date, or units are after period of 9 months from the record date. 3 months and 9 months, 3 months for securities, 9 months for units. You have sold such securities, you have sold such units, and you have earned dividend or income on such securities or unit received or receivable by such person is exempted. So there is a benefit in the form of dividend or any income from such securities is exempted as per the provisions of the Act. So since we are already taking a benefit in the form of exemption of an income, you cannot take a benefit in the form of a loss being set off against other income of the SSC. Then the loss, if any, arising from such a transaction shall be ignored for the purpose of computing his income chargeable to tax, and it will be to the extent of dividend income exempt, meaning the loss will be ignored to the extent of dividend income which is exempt. Correct? So friends, subsection 7 of section 94 we have studied, we have discussed, wherein practical scenario also we have considered. If in practical scenario you inquire, start. If in practical scenario you come across such a situation, then how you can practically deal with it has been discussed. Correct? So friends, this was discussion on bond washing transactions and dividend stripping. In this you can see SSC is somehow trying to take a benefit which he is not entitled to, and deeming provisions are made applicable as per subsection 1, 2 and subsection 7. 1 and 2 are related to interest income which is received by the SSC, which was supposed to be received by the SSC, and subsection 7 is related to dividend stripping, dividend income, and loss from the transactions, both taken together cannot be taken simultaneously. Dividend income exemption as well as set-off of loss cannot go hand in hand. Accordingly, loss which is supposed to be set off is adjusted for dividend income. Correct? So friends, this concludes section 95, which is part of the topic income from other sources. Thank you.